Lovely. Well, we start with session 6 on day 2, and we are talking about emerging technologies, challenges, and prospects for the tax advisor. In the chair we have today for this topic is Ms. Parul Jain. She's the head of the International Tax Practice, Nishit Desai Associates. Please come on stage, ma'am, along with your panelists. Thank you. Give her a big hand, ladies and gentlemen.
Good afternoon, everyone. Extremely delighted and honored to be here at this at this conference, and really it was really nostalgic to see Roy yesterday, and all the professional luminaries here. So without much ado, please join me in welcoming. We have a very elite panel today to discuss a very apt topic, which is emerging technologies. While we are talking about challenges and prospects for the tax advisor, but we are also getting into a little bit of debate on what the tax advisor is really looking for. We're doing a little bit of crystal ball gazing into the future. We are going to be talking about the technology at present, the future of technology, the different concepts of metaverse, crypto assets, and of course, AI. No conversation can be complete without AI, and the role of governments, tax advisors, taxpayers with these evolving technologies. So we all know that the dynamic nature of technology is revolutionizing society. It's affecting individuals, it's affecting businesses, it's affecting legal institutions, governments, taxpayers, tax advisors. All of us are facing a wide variety of challenges and opportunities. Uh, and of course, the challenges are also in keeping abreast with the latest technological developments, including Web 3.0, blockchain, cryptocurrencies, artificial intelligence, new forms of doing businesses, carrying on businesses, whether we talk about chat GPT, whether we talk about, robo writing out submissions as we're arguing before court. And I'm just imagining doing that before our benches at Supreme Court. And I see Mukesh is already smiling at that and imagining, arguing with a live robo in Supreme Court. But Mukesh, we are getting there. And maybe, anyway, I'm sure Gauri is going to talk about that. She has a little bit to talk about fairness and, justice and equality. So we'll see what she has to say on that front. But, on a little bit of serious note, blockchain-based tokenization has increased efficiencies in businesses. Blockchain has been used as the backbone of a lot of businesses, whether we talk about financial institutions. Now we're talking about using blockchain technology even for the tax administration. What it allows us to do is to reduce transaction costs, allow a greater market participation. It impermeates into all the societies, into really areas where physical business models were not able to reach. But at the same time, from a tax perspective, of course, blockchain enables transfers, obscures ownership, and also creates complications in taxation. Um, Governments like to impose taxation on transfer of assets, and when ownership of such assets is transferred via the blockchain technology or an intangible token using or NFTs and using cryptocurrencies, there is a potential for avoidance, if I may use that term, of transaction taxes in a particular jurisdiction. In addition, which jurisdiction gets the right to tax? What are our statutory and constitutional basis for imposing taxes? That also becomes problematic. The backbone of the metaverse, which is the most talked about, you know, uh, talked about Web 3.0 or metaverse. The backbone of that technology is the blockchain, which enables transactions to take place via NFTs, cryptocurrencies. We don't really have a comprehensive global solution today on how to tax transactions taking place via cryptocurrencies, taxation of NFTs, And of course, different countries are following different rules, whether it's with respect to what really gets covered in crypto assets, what really is the characterization of these, of the income arising, and where the users are based and how to really, tax them on from a functional perspective. We've seen, for our Indian practitioners, the concept of VDA has been brought into our Income Tax Act, and it has created more lack of clarity with, even even things like gaming points, or even tokens, which or even listed securities being kind of getting covered under virtual digital assets, and taxation of such securities is becoming a question mark. Leaving aside, we're not even on cross-border credit mechanisms and applicability of tax treaties, which is still an open question. So that's another aspect that we are going to delve into in this panel. We've also seen evolution of online communities using, based on increased interaction between users. We started with the Web 1.0, which was mainly static websites and without much possibility between users and other sites. Then we transformed into the Web 2.0, which was a huge internet revolution with more like society-based and networks, social networks using a centralized network. But now the Web 3.0 is, promises, and which promises to run in parallel with the Web 2.0, brings about a very different way of running businesses. It has an emphasis on decentralization of application, extensive use of blockchain technology, machine learning, and artificial intelligence. And that's what gives rise to the metaverse. Principles of international taxation are getting significantly impacted because of transactions taking place in the metaverse. Especially considering, there has been a lot of talk about, are the current Pillar 1 principles sufficient, if and when the Pillar 1 does become, is really implemented, are these really sufficient to tax income which arises in the metaverse? And the main questions that really arise is how to deal with concept of territoriality, who should be taxed, where should income be taxed, characterization of income. Is India going to tax, let's say, sale of an immovable property in the metaverse, if I may call it an immovable property? Is that really income arising from immovable property? Is that capital gain in nature? Is that royalty income? What really is it? What about interactions within the metaverse or interaction with the real world? To what extent will expenses be deductible? If I can create an avatar of myself in the metaverse, and my avatar can buy, real property in the metaverse, so who's really getting taxed there? Is it me? Is it, someone who's buying the property? What really is happening? So these are also some of the concepts that we are going to be talking about. As and when we delve more into these, these taxation nuances, valuation is also going to become a very complicated exercise. At least in India, we're seeing a lot of taxation based on fair value principles. How do you really value some of these currencies? How do you really value some of these transactions? The context will get more and more complicated, but will probably also evolve as these business models evolve. So what we've really seen is that we will see many new business models and value chains coming in, where the geographical lines between retailers and consumers are getting more and more blurred and are being replaced with virtual reality. But when we talk about tax advisors, and that's how we're going to also segue into the role of tax advisors with all of these complicated tax questions, which may be put up by by Pranav as he leads our panel into these some of these discussions. The application of AI, artificial intelligence, in taxation was relatively unknown to tax advisors, some 10 years ago. Now, with a lot of technological revolution and evolution, and people getting more and more ingrained into use of technology for use of their businesses, tax advisors do understand these tools better and are using them in their daily work. We are already seeing a lot of these tools being used for if I may say, low-end kind of, work like compliances, tax filings, some base, litigation, paperwork, etc. But the possibilities for using AI for, tax administrators as well as for taxpayers are going to be limitless, and we are seeing, the role of AI advancing and the use of technology in everyday businesses. This panel is also going to talk about how governments and tax advisors need to gear up for new technologies and a competitive edge that tax savvy firm may have over the other. But the question that really needs an answer to is, does this really mean that your elite tax advisor will now get replaced by a tax bot? And does it mean that the next conference will see, bots, giving lectures or seminars here as compared to, human beings? And to what extent can human empathy really be replaced by machines? I think that's really a big question mark. So these are some of the aspects which the panel is going to delve into. And before I'm going to ask our panel leader, Pranav, to lead us into a discussion, let me just introduce our panelists here. We have Akim Frost. He needs no introduction, and he was a speaker just before the lunch session, but he's the deputy director with OECD's Center for Tax Policy and Administration, and we are really honored to have him as part of our panel. He brings a lot of experience with respect to how the OECD has been looking at some of these aspects, and that's what he's going to talk about. Akim, I'm not reading out your entire CV because I suppose that's already been done for your pre-luncheon session. We have Professor Liz Chen. Hi, Liz. And it's really late in the night, or should I say early in the morning for her, because it's past midnight, and she's been extremely kind and offered to stay back for the entire session. Thank you, Liz, for that. She's joining us from LA, and she's a professor at the University of California College of Law, San Francisco. She teaches international tax law, and she's the CEO and founder of Formatic Inc., a tech company which is developing automated global business formation and tax structuring solutions. She has served as policy advisor for OECD, where she worked on Action 1 of the BEPS project. She's also served on the Blockchain Working Group for State of California to evaluate California's use and regulation of blockchain technology. She received a bachelor's and master's degree from Stanford University and her Juris Doctor from UC Hastings. She's worked with a lot of, she has a wide range of experience. And, at some point in time, we've all had the pleasure of interacting with her, in our previous, if I may say, avatars in different firms. When she was with Ripple or she was with, with other law firms. Thank you, Liz, and pleasure to have you join us. We also have Dr. Claudio. He's an assistant professor in tax and technology at the University of Amsterdam, where he lectures in advanced LLM program in international tax law. He conducts research on interplay between blockchain and tax as one of the leaders of the CPT project of the Amsterdam Center for Tax Law. He has obtained a PhD in law from Radboud University in Netherlands. He's also a tax lawyer admitted to the Italian Supreme Court. And he's a founding partner of RC Lex, law firm based in Italy. Then we have Ravi Chatlani. He's an LLM graduate from University of Business and Economics of Vienna with a track record of working with international clients in private and public sector. He's currently working with IBFD in the knowledge sector, and he has a lot of experience, on the topic of blockchain and digital assets. He's also participated in the group of advisors that assisted the Panamanian government in adopting international tax standards such as CRS and BEPS minimum standards. Our final panelist is Gauri. She's a partner in the tax practice at SAM, Shardul Ramalchand Mangaldas, which is one of the leading law firms in India. She works closely on international tax planning matters, and she holds a master's degree in taxation laws from Harvard Law School and is admitted to the New York State Bar and Bar Council of India. Thanks a lot. And last but not the least, our panel leader is Pranav Saita. I don't think I should be reading out his CV because he's a very renowned personality in the Indian tax profession, but he's the national leader for international tax and transaction services practice. at EY. He is also a member of PSC at IFA, and he has wide range of experience in anything and everything to do with tax. He's also the family business leader at EY India, and he also has led the TMT sector national head of litigation and controversy practices at EY. He's also plays a key part at the tax knowledge and solutions team. Thanks a lot, Pranav. We are really delighted to have your experience for this panel. So without much ado, let's delve right into today's session. And I'm going to talk. I'm going to request Akim, if Akim, you could start off this session by giving us your experience in this diverse field, and specifically how OECD is really looking at the future of digital transformation of the tax administration. I think we'd be delighted to hear from you. Thank you.
Thanks a lot. And I've used up a lot of my time over lunch, so I'm going to cut into this one. So I'm going to make this short and to the point. I think what I was trying to tell you about here is a little bit where tax administrations are. And when I talk about tax administrations, it's OECD country, G20 countries. We bring them together. There's about 53, the advanced and emerging economies. And there's a lot of discussions on where is the technology going. And in some sense, many of the tax commissioners actually think that their digital project is bigger than our pillar digital projects, because there's a lot more in tax administration. We actually had one chair of the Forum on Tax Administration who's a former McKinsey consultant who, when he started his job, told his people he's going to replace all of them with AI and a computer. He was not terribly popular, and he's not currently the commissioner anymore. But you see that from a tax administration perspective, it's not like a bakery, like there's data in, data out. So if you think about tax administration and digital transformation, you just see the potential. We also have some people inside tax administration, so to speak, the chief information officers that, of course, want to control people like Rashmi. So they want to control the policy people. So they want the policy people to design tax laws that can actually be automated. So you work from the administration into the policy design, and sometimes they're a little frustrated with the sorts of things that we do. But that, I think, is the community that I want to talk about and bring you some sense of where globally I think we're at, and we'll hear more about this. First, I think a word about blockchain. Blockchain is a piece in the suite of technologies that tax administrations are exploring, but it is one in a suite of technology initiatives. It's not the be-all, end-all of all technology thinking, but it is, of course, a part of that. I think the big part that these tax administrations, and we're seeing this in India as much as we're seeing it in China, and we're also seeing it in many of the others, is the concept of digital transformation. And the concept of digital transformation is changing, not digitalization existing processes. So you file a paper return and now you're going to file a digital return, so to speak. It's rethinking the process of taxation by essentially building taxation into the natural systems, the natural ecosystem as it evolves of the taxpayer, right? And then in some sense, as we say, tax just happens. So you can think about it in simple terms. We do this for wage withholding, and that's sort of built into the system. We see this also in other ecosystems where you can put a tax module into accounting software, and then it just happens in the background, and then you can have an API and you can report the information to the tax administration, and sort of tax takes a backstage. And that actually requires a rethinking, compliance by design of the process architecture about how this works. You start with the evolving ecosystem of the taxpayer, you try to understand it, and you embed taxation in that process rather than putting it on top as yet another thing you need to do. And there's some natural advantages also from a compliance by design perspective. There's a lot of work that's happening here around these 53, the Forum on Tax Administration, as we say here, the last meeting in Singapore. There's also an advisory group, so that is open to everybody, academia, business, tax administration, that explores collaborative approaches to get us to that vision. So if anybody wants to join, by all means, come and join us in this world. Now, the couple of things I wanted to mention and really be brief is sort of, how does this actually work? How does this get translated? I'm going to talk very briefly about personal income tax. Then I'm going to talk about VAT, and I'm going to talk about CIT. And this is just giving you a spotlight and no particular country. One, on PIT, I think many countries have moved a long way and increasingly are moving. E-filing sophistication, and in some sense it's even wrong because I think we're moving into a no-filing environment, I guess is the idea. Now that requires us to have reporting sources that come almost real time into the tax administration. And so what does that mean? It's of course wage withholding, but it's also other sources. If you go to some of the Nordic countries on investment income, way before we did the CRS, there was already domestic reporting, and now they actually even use CRS information to pre-populate returns from foreign source income. Now, sometimes there's of course a time lag how you do this, and sometimes it might not be right there. There's the CRS information, I mentioned this. We will talk about crypto. There's a crypto information, e-money as that moves. And then there's other questions where you can have, what do you do with real estate information and some of the work that we do. So in some sense that you can feed that information into the tax administration, and then countries such as Sweden, I don't know what it's in India, you can technically accept your tax return with a text message on your phone. I agree, that's all you may have to do. Now, that doesn't always work, but it's like there is these model out there, that's not the only country. There is AI, of course, improving taxpayer service. You see the statistics that we have on the slide here. But that creates, and I think we're going to talk about it, its own challenges. Whether you think about the Netherlands that used AI for some of the social security and some of the implications I think that we're aware of. AI meets ethics. How far does this go, especially in the PIT? Who controls the AI when the AI controls the data analytics of the data for the individual, especially when it becomes predictive? So there's a lot of challenges and interesting parts, I think, that countries are exploring, but that's, I think, where we are on personal income tax in many countries. VAT, we all have e-invoicing, fiscal tills, etc. But I guess it's not necessarily a good example of digital transformation, because while it substantially reduces a non-compliance angle, it typically has very little in terms of a service offering. And we're only seeing sort of very slowly the thinking of pre-populating VAT returns and how can this vast data that is being generated be used to simplify the work of the tax advisor, and also importantly, the work of the taxpayer. And we of course see also that every country has a better e-invoicing system. And so if you're a large operating multinational in several countries, you're now exposed to the Italian system, the French system, hundreds of other systems. So there's also a question whether that couldn't be standardized. So it's not just that little bit different in every country that you operate. And that you can also think about how can this information be used for the taxpayers? How can we integrate it? How can we get that service component in there, where I guess many of these systems, while very important from a compliance perspective, which is also why they were introduced, what do they do from simplifying the affairs of the taxpayer? And then my last point, see, I'm actually being relatively quick. What does it mean from CIT? Do you see where we are on pre-filing? And in the pre-discussion, we also had an interesting conversation. What does this do for the compliance culture, in particular of small businesses? We do have a number of countries that allow small businesses to integrate their financial accounting software if it is certified. Not every piece of financial accounting software, but to the extent it is certified. And through an API, they have a direct link into the tax administration. So you can substantially reduce the compliance cost of some of those small businesses by having a pretty compelling service offering, which we also think will reduce the risk appetite of some of those to even engage in the planning, because if you make it sufficiently easy, we sometimes forget, that also reduces quite substantially the probability of non-compliance, which might be deliberate, but it may not be deliberate, maybe an error. It may just be because we're making compliance so difficult. So working towards the taxpayer solving the tax problems and bringing him in a friendly and service-oriented ecosystem will also substantially reduce non-compliance as a result of the business person can actually go on doing the business as opposed to having to worry about the tax. And again, that's the idea of taxation just happens. For the role of the tax advisor, of course, that becomes a slightly different role. You need to have experience in software solution. You need to think about how you can help the customer install some of this. There's a certification process. So there's a lot of this work, especially in the SME sector. But we're also seeing data automation approaches coming into the large business segment, and I think Pillar 2 is accelerating the trend. And this is my pitch from yesterday. There's a great business opportunity for the Indian software information to crack Pillar 2. We were joking that, some of the accounting firms in some of the European countries are making a lot of money by providing these tools, and I was jokingly saying, but probably the programming is happening here, and the money might not be here, so you might want to change that. But it is financial accounting data points that are already in ERP systems that need to be extracted for compliance with Pillar 2. So it also is an opportunity to rethink how some of the compliance can work as a result of having some of those pre-programmed data points that already exist in systems, which to us, and this is, I think, already my concluding comment here, also is something that we're looking at in the Forum on Tax Administration, how you move from an audit-based model to more of a systems assurance model. And when is this possible also in the large business space? This is a very big backdrop. I'm certainly not as advanced as some of the discussions on crypto and the metaverse. I think we'll get to this. I leave that for now, and I will join the panel on those points. Thank you.
Thanks a lot, Akim. I think our takeaway from an Indian regulatory perspective is that soon we will see some change in laws to allow tax practitioners enter into partnerships with software engineers and share profits with them. So let's see. I'm at least looking forward not to file my tax returns. I always file my tax return on the very last day, so that will be a relief. Thank you so much. We are going to have Liz coming in now. She's going to be a good precursor to a panel discussion. The way that we've divided our panel discussion is that we're going to have three subtopics. We're going to talk about crypto asset taxation and challenges in the current and future environment. We are also obviously going to be talking about technology impacting the future of work and the tax challenges and opportunities that it brings. And then finally, but not the least, we are going to use it as a nice segue into challenges which arise with the advent of Web 3.0. But I'm going to ask Liz to come in. She's going to give a good backdrop of and given her experience, she's going to talk about evolution of technology and how our existing tax framework can apply to current and emerging technology. The current rules, Pillar 1, Pillar 2, are designed to address technology and business models of the past and to a certain extent to the present. But can they really be applied to a truly decentralized or a virtual system? Yet to be seen. Or, as Liz has been talking to us about, space-related economic activity that is coming pretty soon. So Liz, over to you. Thank you.
Great, thanks very much. Getting started, I just wanted to say that it's a great privilege and honor to be invited to participate in this conference. So thank you. So I wanted to share, a little bit of, let me see if I can, there we go. So a little bit of the timeline of human technology, right? And in looking this up myself, I was actually shocked at some of the information that I learned. So in terms of sort of human technology, or it really begins about 3.4 million years ago with the first use of stone tools. And then from there, and granted, the archaeological record may be spotty in some places, but from there, it then took humans another 2.4 million years to control fire and use it for cooking. Right? And then if we then fast forward, so you can sort of see in this timeline of sort of when humans sort of first appeared on this planet, 3 million years ago, and then essentially all of the the main sort of technological development that's now happened really in the last couple hundred years, it's really quite remarkable. So this is actually just more of a zoom of that last spike, right? And so here you can essentially see really beginning, around the 1500s, you essentially have the invention of the printing press, right? The microscope, then you have steam locomotives. And then from there, it just really accelerates, right? Really the last 100 years, 150 years, it's been just tremendous, the advancement that in technology that humans have made for better or worse, right? Because you also see here the invention of the nuclear bomb. And I think what's quite interesting here is that this acceleration in technology development is solely because of human intelligence. And I think what's interesting now is when we talk about AI and we talk about sort of all the different ways that human intelligence can be amplified or supported, what does that actually mean in terms of what the next, the decades, centuries look like, right? And I think what's quite interesting here then is what does this mean, right, for how we think about, not even talking about tax for a moment, but how do we think about creation of value, right? And what does that mean, right? Like in terms of creation of value, from there, we then talk about, well, what does that mean in the context of corporations, in the context of humans, right? We have to start then now talking about humans versus non-humans, right? Or maybe humans versus amplified humans, right? Like base model humans, right? Versus amplified humans. And then full on to, fully automated, robots, right? Who have some level of cognition. And then how do we think about like value creation and where is something done, right? Where is that value created? So if we then like think about tax, right? So, what are the underlying principles of our modern sort of international tax system? So there's this sort of, source market versus residence, right? Which is sort of a lot of what BEPS 1.0 was about, as well as the Pillar 1 project. This notion of value creation, right? And I think, where is value created? Taxation occur where that happens. And then this question of, if we think about like software, right? Like, it's interesting, hearing Occam's comments earlier when, he had a vision of having tax built into systems. And I would actually love that. I think that would actually make our lives all a lot easier as sort of practitioners and people who have to prepare and review returns. But I think it's a bit challenging when, between countries, you can't even agree on what is considered software revenue, right? And does it matter whether something is shrink wrapped, or what happens if it's software delivered as a service and paid for on a subscription basis, right? And so what is that then in terms of the definition of that revenue? And I think what's even more interesting is now, even within a country, right? Like in the United States, there's controversy around what is the definition of income. So I don't know how many of you have been following the Moore versus United States case that's now currently in front of the Supreme Court around whether unrealized gains can be considered income for current taxation purposes. And so if we go back and sort of think about like what are some of the other components of modern international tax, it's increasingly we see sort of everything being done as a service, right? So things that actually used to have a proper definition that we could then put into a particular category for tax purposes, what happens now all of a sudden if it's done as a service? Then do you tax that as a service? Or is the service really just a derivative product of that underlying thing? What's the role of agents and intermediaries? As we sort of talk about blockchain and metaverse and other technologies that are very much going to become a reality in our lifetimes, and we're already seeing early forms of it now, do those entire sectors disappear? Are all those roles essentially replaced by some type of automated platform or zero knowledge proofs? And of course, this then goes to the question of character and source, right? So essentially, what is it, right? And we can we'll discuss more of that later on in the conference with some of the other panelists as they sort of talk about blockchain, metaverse, and AI. Is in a lot of these areas, the question of what is the revenue, and fundamentally, what is the transaction changes. And then all of this, I think brings to mind, what is the role of our existing tax convention, right? I'm not sure actually, because our existing tax conventions are essentially written in a very you know, 20th century world where a lot of things happen and are built physically. And I think as we move into the next decades and into the next century, I think that we'll see a lot less of that. And so, you know, I think what was mentioned earlier was that this current overhaul, this current international reform of the existing international tax system, it's very much looking at the business models and the technology of both the past and to a certain extent the present. And I think, and not just the business models, but as well as the behaviors. And I think what's interesting is we're already seeing those behaviors change. And so is the existing system fit for purpose to evolve with business models, technology, and human behavior? And is the system ready for what's coming? So then that leads the question of, well, what is coming? So this is sort of a bit of a scatter shot of, you know, a lot of the very interesting ideas that are out there. And some of them are actually already, they've been introduced as prototypes. There's been quite a lot of academic research in a lot of these areas. I think, for example, right, 4D printing, right? With, you know, 4D printing is essentially 3D printing with the fourth dimension being time. And I think there, you know, 3D printing has fundamentally changed how we think about parts and supply chains, right? You know, all of a sudden, you know, when you think about buy sell, you know, like buy sell or distribution type of agreements, right, in a cross-border tax context, what happens now if you just essentially send the 3D printing instructions and then somebody just prints it on site? It fundamentally changes essentially the character and the source of that transaction, right? And as a result, it changes the taxing rights. And now with 4D printing, you know, when you introduce the fourth dimension of time, there, it's essentially, you know, the idea would be that, you know, something that's printed 3D, you know, it's already programmed within a certain period of time or with an introduction of an additional environmental factor to change into something else, right? So perhaps change into a different part, perhaps change into, you know, something else, right? Like I think a lot of the literature that's out there talks about maybe furniture, right? That starts out as one thing and changes into something else, or an industrial part that starts out as one thing and changes into something else. I think what's also interesting is this, you know, there's quite a lot in the literature around neuromorphic hardware, right? That's essentially the idea of having the neural pathways that are in the human brain essentially replicated and essentially saved on some hardware device. And presumably, you know, the vision of something like that is that that's able to actually replicate a lot of human decision making and thought. And so when we then think about tax concepts like management and control, right? The question maybe then becomes, is it possible to one day print a copy or download a copy of my consciousness onto a hardware device and put it somewhere and then essentially say, okay, well, my company is being managed and controlled in the place where I put my hardware device, right? That essentially has a copy of my consciousness and is able to make decisions the same way that I would. So I think this is sort of, you know, these are examples of what's to come. You know, there's a lot of, you know, Pearl mentioned, you know, there's a lot of sort of technology and development that's happening related to space and aerospace. We're already seeing companies invest quite a lot of R&D in asteroid mining, right? So essentially mining for all sorts of necessary minerals on various asteroids. We're also seeing, for example, you know, the delivery of pretty decently fast internet via low Earth orbit satellites. And so, you know, again, when we think about things like, well, you know, at least in the US, right? In the US, services are taxed at the location of performance. So if we think about providing internet as a provision of a service, where is that service being performed if the satellite is orbiting the Earth? So I think, you know, these are all sort of questions that have not been, I don't think any tax framework sort of really has considered this yet. And then as we sort of think about like settlements on Mars or on the moon, um, who has jurisdiction, right? Who gets the tax income generated from, whatever Martian colonies or lunar colonies? And I know it all seems like very fantastical, but uh, I still remember when I was making a phone call using a phone where I had to like dial with a little like circular rotation. And now look at how we communicate. And that's just, in my lifetime. And I think I'm still relatively young. So I think, when we think about what's to come, I know, the focus of the international tax world is very much on solving the, the issues of yesterday and today. But I think it may actually behoove everybody to maybe give a little bit of thought of what's coming. And in this way, we'll be better prepared. And hopefully then it won't be another 10-year-long international tax project, although it's been quite exciting, I have to say. So I think, with that, this is sort of something I've covered already around, the different sort of, how we think about like technology and taxation of value creation, how we think about technology and how they'll help tax professionals and administrators. And then also, a lot of the technologies that are starting to emerge that essentially our system doesn't address at all. And I think within each of these, our panelists, as well as the presenters, will go into more detail on each of these. So with that, I will hand it over to, I'm not quite sure who I'm supposed to hand it over to. So I will leave it to Parul.
Yeah. Thanks a lot, Liz. That was a very invigorating presentation. Looking forward to seeing what the future holds for us. And now I'm just going to hand it over to Pranav to please take over the proceedings of the session. Thank you, Pranav.
Thanks so much, Parul, and thanks Akim and Liz for the initial takeoff with great presentations. We will now move on to the panel discussion. We have 3 themes that we've chosen for this afternoon within the overall umbrella of the topic that we have this afternoon. I must admire the organizers for giving an old-fashioned tax professional, age-old tax professional, the task of leading a panel discussion on new age business models, none of which I understand, I must admit. And I have all the questions, but I didn't even know this time what questions to ask. Otherwise, generally, I'm good at least figuring out what questions to ask. But this topic was such, I was struggling even to figure out what questions to ask. But anyway, looking at the topic, we have 3 themes into which we've divided the panel discussion. One is cryptocurrencies, all the challenges and prospects arising in terms of taxation of crypto assets. We then move on to the topic of how technology is shaping the future of work. And by work, typically here we mean the work of tax advisors, tax administrators, probably adjudicators, taxpayers as well, and so on, and what artificial intelligence and all the new emerging technologies do to that particular space. And finally, we'll move on to Web 3.0 in the last of the themes. So firstly, let's invite Claudio to give us a little overview on crypto asset taxation, and then we'll have a quick discussion amongst all of us. Claudio. So that's the way we formatted it. For the first few minutes, each one will take lead on making a presentation on that theme, and then we will discuss that theme. We move on to the second theme thereafter.
Good afternoon. Let me first thank the chair of the panel, all my fellow panelists, and obviously the FIT and the IBFD for having invited me. I'm very honored to be here today. With my presentation, I will delve into the complexities of crypto asset taxation. I think that understanding the tax implication of crypto assets is fundamental also for tax advisors nowadays. To this scope, I believe that the first necessary step is to identify the taxable events of crypto assets. What are basically the taxable events that may emerge when we perform transactions on crypto exchanges or simply when we keep our tokens in our portfolio? Well, tax literature, tax scholars across the globe have proposed a categorization which is based on the broad life cycle stages of a crypto asset token. We have the first stage of the origination, the second one of the use, and the third of extinction. Well, origination involves the very first sale of crypto asset. This can happen, for instance, in the case of an initial coin offer or other market sales to selected investors. But we can also have origination through remuneration or incentive. Let's think about the case of staking rewards distributed to miners or validators as a contribution, as an incentive for the work for the consensus mechanism. Then we have the second life cycle stage, which is the use. Here we have the most notable example, which is that of Bitcoin, which are used as a means of payment. And then we have also the example of speculation or investment. Also in this case, we have the use of a crypto asset token. We have the situation of token holders that simply keep in the portfolio a certain amount of tokens and they wait for an increase in their value before selling them to obtain a gain. And finally, we have the extinction. I would say that one of the most interesting examples is the redemption of the so-called stable coins. With the redemption, stable coins are destroyed, and this happens when we exchange them for an equivalent amount of fiat currency. All these situations involve taxable events, and in the very last years, countries across the globe, tax administration have been called upon to address the tax treatment of all these taxable events and find solution in accordance with the principles of the tax system of reference. Well, not all the countries have clear guidance regarding the tax treatment of these taxable events. But this does not mean that crypto assets are not to be taxed. This means that it is for tax advisors to identify the appropriate tax treatment and to find solutions that are in line with the rules in force and the jurisdiction under consideration. Well, to identify this tax treatment, the very first step is the legal characterization of the underlying operation. This is because domestic tax laws usually treat the transaction differently based on the legal form. That is the reason why legal characterization comes first in this analysis process. Here, it is really important to understand how the underlying technology works. In this kind of situations, the difference between a public blockchain network or a private blockchain networks, or the possibility of delegating network usage rights, these are all variables that can really make the difference for the legal characterization of our crypto asset transactions. However, I think that tax advisors should give a priority to a legal characterization based on existing legal categories, on existing contractual schemes within their legal systems of reference at a domestic level, because this way they can easily find some safe harbors and also more legal certainty for their clients. However, it is not always very easy to define the legal characterization of these taxable events for crypto assets. We have the example of staking rewards within crypto staking. There are still open questions. The legal characterization is still very controversial. Open questions, for instance, are should we consider staking rewards as a product of a contractual relationship, or should we consider these staking rewards as new created property, or maybe as an accession to wealth, meeting the broader definition of gross income? Then the second step for identifying the tax treatment of these taxable events for crypto assets is that of income qualification. Income qualification based on the legal characterization. This means to identify the income categories of a given transaction in a way which is consistent with the technology substance of the operation under consideration. Well, with this respect, the issue of income qualification is strictly related to the alternatives between taxing crypto assets upon receipt or taxing them upon disposal. This is extremely relevant, in particular in the case of crypto staking again, because if we tax staking rewards upon receipt, we will apply their ordinary income tax rate, while if we tax staking rewards upon disposal, we will defer taxation and we will apply in the end capital gain tax with the lower tax rates in this case. So these are all still open questions that can seriously influence the crypto assets investors' decision, and also the possibility for revenue agencies in different countries to collect revenues. Then we have one more important issue. To ensure tax compliance, countries across the globe are also required to introduce the necessary measure to track crypto asset transaction, to find a way to identify these transactions and to monitor this kind of activities. In the international tax landscape, we can easily identify some reference model that all aim at enhancing transparency and to make this tracking possible of these crypto asset transactions. The first model that we have is that of the OECD CARF. These model rules are all intended to impose due diligence procedures and reporting obligation on the reporting crypto asset service providers, such as crypto exchanges. Then we have a second model that is the EU model of the Directive on Administrative Cooperation. We recently had a seventh amendment to this directive, known as DAC 8. And there we have again some rules that more or less they largely reflect the structure of the OECD CARF, but their scope of application is broader because they also apply to non-EU operators when they have reportable users resident in the European Union. The third model is that of the US FATCA. In the US, foreign financial institutions are required to identify their US citizens as clients and to report to the US tax authorities all the US source and foreign source payment received on behalf of these US clients. And then obviously we have to mention the Indian TDS. This is a 1% tax deducted at the source, which applies to crypto asset transaction exceeding a certain threshold. And also in this case, the objective of this tax is to monitor the activities of crypto asset investors and to track the related transactions. All these different reference model raises some very important questions. What can we do, for instance, in case of crypto asset service providers that do not comply with the reporting obligation? And especially, what if these crypto asset service providers are established in a cooperative jurisdiction where it is not possible to enter into negotiation for the agreements for exchange of information? Well, this is the context where tax advisors are called to work nowadays. And I believe that all these open questions will contribute to make really exciting our panel discussion. Thank you.
Thank you so much, Claudio. One quick question Is there an emerging technology to keep me awake after a sumptuous lunch? Anyway, jokes aside, coming to the topic on crypto, before we go to crypto staking, which I would like to certainly delve upon, let's start from very basic matters. Is cryptocurrency money, or is it some commodity or goods? Is it property? Is it securities, financial instruments, actionable claim, capital asset? Where exactly do we categorize a cryptocurrency or an asset? And what is the situs or the location of an asset? Maybe we can start with you, Claudio, and then move on to...
Yeah, I would say that there is a general consensus nowadays that we cannot qualify crypto assets as financial instruments, but we have to qualify them as a property. I would say that more or less, among different tax administrations across the globe, there is this general consensus about this.
It's an intangible asset?
Yeah, exactly.
Okay. Any of the other panels, Liz, would you want to add? We were talking during your presentation of, the traditional methods of taxation, source-based, where value creation happens, residence-based. Where would you say that some of these incomes arising from crypto assets that we are talking about, where does the income arise? What is the situs, the location of that asset?
Yeah, I think there's no fundamental characteristic, right, for the crypto or the digital asset itself. You actually have to look at the context of the transaction that it's being used in, right? So in certain cases, it's being used as akin to some form of payment, right, for exchange, right? So in that case, it could actually be used analogously to money, right? In other cases, it's being used as a right for future services, right? So there are sort of, NFTs out there that, you purchase this and you essentially get, access to a particular club or to a particular concert. In addition to that, you get to go backstage and meet the artist. So that's essentially almost like a payment for some future service. There are still others where, based on the context, you do have digital assets that really behave akin to some type of equity instrument, right, or security or instrument. And then you have yet others that are nothing but almost like in-game currency, right, in a closed-loop video game. But I do think you have to look at the context of the transaction. You also have to look at things like liquidity, right, because is it something that's listed on the market? Is it tradable? There are a lot of crypto assets. I think last I looked, there are over 2 million listed on CoinMarketCap. And most of those have, very thin trading books, which means that, I think some of them are like vanity coins, right? But no one's really trading in them. But then still others have actually quite deep trading books. And so I think you have to look at all of these factors to determine character and source. There's no sort of, I don't think that there's a static definition for digital assets.
Yeah, please, Ravi.
So one of the reasons, one of the things a lot of jurisdictions seem to do when they try to evaluate whether it qualifies as property or it qualifies as currency, at least on the topic of currency, as to why so many jurisdictions discount it as currency, is because there are certain objective criteria. So there are certain objective criteria that central banks use in order to determine whether something is currency or not. And these two criteria are, does it meet the economic criteria and does it meet the legal criteria? So your economic criteria is sort of, is it a medium of exchange? Is it universally accepted? Does it have its own independent unit of account? And so many central banks seem to conclude that it doesn't really meet those standards. And on top of that, from a legalistic perspective, it's not considered legal tender. So you need to meet those two objective criteria in order for it to be viewed as currency. So that's one of the arguments as to why they discount cryptocurrencies as a whole from being a currency as we know it, as a fiat currency.
Right. Excellent. Thanks so much, Ravi. Let's go on to crypto staking, which was also the subject of your discussion during your presentation, Claudio. So how would you regard in principle concept as the right way to tax income arising from crypto staking? Should it be on receipt or should it be on disposal? And maybe then we'll request Ravi also to chip in, but happy to have your initial thoughts, Claudia.
Yeah. Yeah, I see that most tax authorities in different countries are issuing guidelines according to which staking rewards should be taxable upon receipt. And also there are several scholars that basically endorse or support this kind of approach, taxing staking rewards upon receipt. They use some policy justification to support this. They basically argue that the idea of taxing staking rewards only upon disposal would be unequitable because it violates the basic standards of horizontal and vertical equity. I do not agree really with this kind of approach. Fundamentally, where we have to take a decision, I mean, as tax authorities or the legislator, when we have to take decision regarding the tax treatment, we cannot see only the policy justification to get a decision about this. We also have to consider how the technology works, how is the underlying operation from also the contractual point of view. In the case of staking rewards, if staking is performed on a public blockchain, we have to consider how this public blockchain works, which are the features of the public blockchain. A public blockchain is decentralized, there is no controlling entity, and consequently, we cannot find a counterparty in the staking activities. The activity of the staker does not have any counterparty. So if we start from this assumption that derives just from the understanding of how the technology works, I argue that we have to tax staking rewards only upon disposal. And I do not agree with the approach of most countries that is essentially exclusively based on policy justifications. And for this, as other scholars did, there is a simple example to put on the table, that of a cake baked by a baker. In that case, it's very simple. When the cake is just out of the oven, there are no countries that apply taxation there. We have to wait for a disposal. And only when there is disposal, that case is taxed. And it is the same for what regards the staking rewards, because also there, staking rewards are the product of the validator efforts, of the sub-validator efforts. There is no counterparty, and it is not possible to qualify that as an interest deriving from a deposit agreement, because a deposit agreement requires a counterparty.
So just to take that a little forward, if I was a miner, maybe I earn some cryptocurrency. If we go back to the previous point, by and large, everyone seems to feel, except maybe a couple of countries, that this is not legal tender, this is not money, cryptocurrency isn't money. It's probably property, a capital asset, intangible asset, whatever you have it, but it's certainly not money. If a miner puts in efforts and earns, so to say, cryptocurrencies, how can it be taxed when that cryptocurrency is, so to say, earned, brought into existence, or whatever you call it? Isn't it similar to maybe a painter starting with a canvas and some paint, putting in place or bringing into existence a painting? As soon as the painting comes into existence, he can't be taxed. He can only be taxed when that painting is eventually sold for a price and he gets something out of it, because that painting is not money by itself. It's an inventory or a capital asset, depending on business or capital gains. Whatever that capital asset that has gotten created, self-generated, is by itself not money. It's not income earned at that point of time. Income gets earned when the painting is sold. Would you agree, Ravi, with that? I'm sure you had some thoughts, so it will be good to understand your thoughts as well.
Yeah, so I take an opposing view to it being sort of on disposal. The way I think many countries seem to analyze this, they view it taxable upon receipt. And the reason is there's twofold. You know, there's an activity that the validator is doing. So we can't deny that there's an activity that's being done. And that activity benefits a user. So when the user makes a transaction, the validator on the back end will perform an activity. And so the reward that he's receiving, really on the one end, countries might want to view that sort of as a business activity that generated a business income. And so the benefit of taxing it upon receipt is that very early on, for the tax authorities' perspective, from the government's perspective, is that I get to receive cash flow much sooner than if we did it on disposal. The disposal means tax deference. And so, for a government, it makes more sense to be able to first get that information early on. The moment that I receive the crypto, hey, I want to know that all of the crypto that's been received, and then I want to tax it at that moment. And on the second element is that later, once that crypto has been received, at some point, if the validator wants to sell it, the tax authority already knows of that crypto, right? Otherwise, the tax authority would not have that information early on. So there's a policy reasoning as to why you would want to tax upon receipt. Is on one end, you get that information early, so that when it's sold later, you already have sort of that cost of receipt. And the second element is because there's cash flow that's generated for the government to being able to tax it earlier rather than later.
And so just
Right, very quickly, under VDA, the Indian concept of mining cryptocurrencies, where do you stand, Gauri?
So I think that in India, we've the kind of nuanced debate that we're having here, and it's also subject matter of a US case in the Jarrett case. We've not had that kind of debate in India, and the broad understanding is that maybe you see mining as a service that the miner is performing for the community, which is your blockchain community, and the reward is a compensation for that service. So I think the view that's being taken in India is that again, the crypto that you receive upon mining or upon proof of stake, where you carry out the validation activity, that would be taxed on receipt as your business income.
It's the same as taxing the painter as soon as he finishes the painting.
I would say that
and value that painting and tax him on that, whether he finally is able to dispose of the painting or not.
I think the nuance here is that when you're saying that I'm creating a painting, you understand that you're the creator, right? But is it that easy when you're talking about when there's being a token being created on the blockchain? Are you the creator of the token, or is the inventor of the blockchain?
As someone said, I grow agricultural crops. As soon as they grow, I'm taxed. Whether I'm able to sell them or not sell them is beside the point. Now, whether I grow them or nature grows them or the land grows them, no one knows, but fine. So as soon as the crop grows, I value the crop and pay tax. That's the concept. It doesn't seem to be...
So there are different ways to think about it, right?
Sure, let's go on to the next topic, crypto reporting. And Akim, I would like to bring you in here on the CARF and what your views are in terms of crypto reporting and how do you think this can be made more enforceable, internationally consistent and coherent amongst different jurisdictions and so on?
Yeah. Thanks a lot. Let me come in, and on this one and maybe on the broader point. I mean, first, we probably see that chart that I think you see probably a little different here. I think that we see the EU DAC 8 as an implementation of the OECD CARF. We very often have seen this in the last, that essentially, there's always a bit of specialty, right? Because Europe is special, so there may be an add-on feature. The US, of course, very special, but if you look at the statement, I think, of countries 2 weeks ago on Friday, by now we're at 54. The United States is one of them. And India is co-chairing our work. So in some sense, there is an emerging crypto asset reporting framework that builds on the architecture that we've done for the CRS, but needs to expand it and extend it, which is the whole reason that we're doing this. There are a couple of challenges I think that we will be talking about, which is, of course, when you have decentralized platforms, how does the reporting work in this space? The centralized platform, you have that sort of third-party reporting model, but who is the person in that creation chain that we're describing here? I guess also that's why the staking is kind of an interesting one, because you're bringing in the information point and having the information, who would report the information if we did have the reporting obligation. What is that environment? And maybe just two observations on that, where we cover some, I think, in the crypto reporting framework. But essentially, when we impose reporting obligation, typically, and that was the same in the CRS, we follow relatively closely the developments in the AML space, right? Because first of all, there's a concern that isn't a tax concern. There's also concern on money laundering, financing terrorism. There's a whole host of sort of a dark side to all of this, where the FATF, as the standard setter on the AML side, brings a reporting obligation. There's very active discussion. What do you do in the space around decentralized platforms and the evolution? But it's a space to watch, I think, where we may have to do more as technology evolves. I guess coming back to tax administration 3.0, it's almost as the ecosystem evolves, reporting obligations evolves, but certainly governments, I think, will not give up that space and create that unregulated with no information where you can store and transfer value. Maybe just on the substantive part to say we did some work on the different tax treatment of crypto under the different aspects or so, but that's already 2020. So for anybody who wants to read up and you want to know what it was like in 2020, it probably doesn't tell you much. There is still some publication out there.
Yeah, Claudio, you want to sum it up very quickly and then you move on?
Yeah, very quickly. Well, here the main problem in my view is that when we consider the peer-to-peer transactions with crypto, or where we consider transactions performed through decentralized exchanges, there basically we do not have a controlling entity that can act as a third-party information holder. We do not have there centralized intermediaries, obviously, and therefore, who is the entity having the obligation and the possibility to report? This is the big question here, and I think that to solve this, we should focus less on centralized intermediaries and start to promote a kind of new approach for tax authorities, to train it also tax authorities to know more about blockchain technology, and maybe to become also part of the networks, to participate in the blockchain networks and to see what happened there.
Yep, Gauri, maybe you can take up the next topic, technology and the future of work.
Okay. Hi, so good afternoon. And again, thank you for having me. It's been such a privilege and an honor to be part of such a fabulous conference. So as we're all aware, and Akim sort of set the stage for me, the tax ecosystem in which tax advisors operate, right, it's been transformed significantly by the use of technology, both by tax administrations and businesses. And so what I'm going to do over the course of the next 10 minutes is talk a little more deeply about what is the state of the use of technology in tax administrations, using India as an example, because that's the ecosystem I operate in, and how a business is responding to this. And what I want everyone to think about while I speak of this is that how is the role of a tax practitioner changing in this evolving ecosystem? So very quickly, if you look at India's journey, digital transformation journey, India's had essentially a two-pronged approach. Number one, that we've seen the country come up with a number of tax and non-tax measures to move towards a cashless economy, because you can't really deploy technology tools if you don't have a digitized record trail. We've seen bold measures like demonetization, the introduction of GST as a digitized tax, and of course, a stellar digital payments infrastructure. On the second leg, we've seen India work on what the OECD calls the building blocks of a digital administration across our customs, GST, and income tax departments. So if you see in the field of digital identity, your tax registrations across these three departments are interlinked. The Ministry of Electronic and Information Telecommunications is now, dabbling with this concept of federated digital identities, where you will have a digital architecture where these registries are interlinked and interoperable and act as a source of truth amongst each other. In the field of taxpayer touchpoints, you'll see all our tax departments have an e-filing portal, through which all taxpayer services are accessed digitally. So every aspect of the tax administration process, right from your registration, your filings, your payments, your refunds, your assessment, everything happens through these portals. And we know the amount of work that's gone in over the years to sort of bring in all the bells and whistles of chatbot and have a one-stop shop with a single dashboard for a better user experience. And then finally, data management and integration. So both the income tax and the indirect tax departments now have their own business intelligence platforms where data from all the varied sources, from your TDS reporting, from social websites, from automatic exchange of information, from the Paradise or Panama Papers, everything is integrated such that we have a automated risk-based system and a data-driven system for tax audits. And this was just to extend an overview, but what I want to talk a little more deeply about is how is the Indian tax administration experimenting with some of these technologies? And let me go one by one. So the first I want to talk about is the faceless assessments. And I know that everybody here who's from India is very well aware of it. But for the international audience, if you want to understand it very quickly, think of a blind date, except that on this date, there is a curtain between you and your date, so you can't see them. So previously, the way assessments were carried out in India was that your jurisdictional assessing officer, within whose jurisdiction your business was set up, would carry out your assessment, whether it was done electronically or physically. And now we've moved to sort of a more centralized process where the government has set up a new organizational structure where we have what we call the National E-Assessment Center that centrally controls the administration process. Now, what does that mean? That basically means that there is no human interface, not intervention, interface, between the taxpayer and the tax administration during the administration process. What the government uses is an algorithm which is based on AI and machine learning to allocate the taxpayer's case to an assessment unit which is sitting behind the curtain. And so why I wanted to sort of elaborate on this use case of technology is because it promotes, or it seeks to promote, transparency, because we've eliminated human interface, accountability, because all communication with the taxpayer is routed through an institution called National E-Assessment Center, and every document has a separate document identification number. And what they seek to promote also in the long run is functional specialization. Maybe in due course, when you have tax administrators, authorities acting as a collective pool, there will be standardized responses to standardized issues. Another use case that I want to talk about, is API integrations in GST invoicing. So what we have now is, again, many of you may be aware that your accounting software, accounting ERP is integrated with the e-invoicing system such that your invoice from the accounting software is automatically registered with the government's department. Again, an example of, tax administration processes sitting in the natural systems of the taxpayer. In the examples of IoT or Internet of Things, in GST, it's important to determine whether or not the goods have reached their final destination. And now what the government mandates is that your transporter carries an RFID device where the e-way bill data is uploaded onto it. So when the vehicle is moving on the highway, the FASTag reader will sort of collect that data, and the government will have real-time information on where the vehicle is. There's also discussions here and there, if you search on Google, about the government exploring API integrations for tax deduction source purposes. And this API integration will be probably based on blockchain. Who knows, maybe they'll also have a smart contract where your accounts are debited instantly. But all these ideas are being explored by the government. And before I finish and talk about what the future state looks like and where we are going with this, I also want to briefly talk about some of the use cases of blockchain that the Indian government is experimenting in, right? So we're all aware that under the Indian law, for example, banks are required to withhold tax on interest if your interest income exceeds certain monetary thresholds. Now, typically banks would rely on self-declarations made by the taxpayer because they don't have access to what is the interest income being earned by you across your banking relationships. Now, the Indian government sort of did an experiment with Infosys where with 10 banks, a blockchain-based distributed ledger was implemented, and real-time information was received on whether interest income has exceeded the monetary threshold or not. And whenever it did, there could be an intimation sent from the tax department that now is the time to withhold. So but there are many other small use cases that they're exploring. And with blockchain, you think big, but you always start small. So the question is, where are we headed? What does this mean for us as tax advisors? Where we're headed is what Akim, sort of pointed out, was tax administration 3.0. The idea is for the administration to sit within the natural systems of the taxpayer. If that's jargon to you, what that essentially means is that your ERP software, the ecosystem in which you operate, your vendor, your customer, the third parties, all of that would be integrated with the tax department system such that there is a real-time information flow with the government. And possibly with AI and machine learning tools, they'll probably be able to give you, certainty on issues like classification, etc., again, on a real-time basis. And if it's still hard to understand, think of this. In the existing system, even with all these technological tools, right, compliance is still a choice. You choose to report in your tax return periodically what you've earned, what you've not earned. But we're now moving to a system of compliance by design. And then what's really changing is your agency to decide what you report and what you don't report. But at the same time, also ease in administration and sort of better taxpayer facilities. Quickly, before we segue into discussions on how this impacts the taxpayers, you also see businesses, on the other hand, responding to this, right? There's this new emergence of tax tech. In the morning, I was seeing advertisements, both like, on how of various tax tech tools that you can deploy. And interestingly, businesses are also mirroring some of the same processes of digitizing data, automation, data analytics to get insights, right, to catch up with the government. So with this, I think we're ready to segue into discussions.
Excellent. So Akim, I'll go straight to you in the interest of time. We are talking of emerging technologies, and we are talking of the future of work and our own future, whether we'll have any work at all, forget the future of work. So in all of this, where do you see who's going to win this race? Is it going to be the tax professional, the tax expert who will adapt and use technology, AI, and all of the others to come out trumps? Or is it going to be a technology expert professional who will learn tax and come out trumps? Is it going to be tax experts imbibing technology, or technology companies going to be tax advisors of the future through the tools they build? Some crystal ball gazing.
Yeah. Now, this is all crystal ball, and this is very interesting. We were sort of joking, saying that some of the work Michael has left that we do at the UN and the OECD, I think we'll have some time until an AI will do this. I will not tell you why, but I will tell you privately. I think we're going to see a mix of this. Like, there is going to continue to be bespoke advice for some of those transactions that we're not currently having and may not have in the reporting system. I think there will be a segment of the taxpayer population that, with the service offering and the integration here, maybe we can let them out from where they currently have to do the filing, and the low end of the work, I think, will disappear. I think it will have, depending also on the tax type, when we think about it, like the VAT may have a different dimension to PIT, to small businesses, to large businesses. We shouldn't forget the tax types here. That it may have it may have an impact on compliance behavior. It may change a bit where you find yourself on the compliance pyramid, and how you act and the behavior might change. I think we will see more technology coming into the traditional tax advisor role. There's questions on, bar association, regulatory, professional standards that will also come in, the ability of bringing some of these expertises together. And so it's an interesting landscape that I think we will see evolving. We will also see, I guess, that some of those activities will create new advice dimensions. For instance, one of the dimensions that we certainly see in some of this, and we talked about it in the pre-meeting in Europe, is that there's an aspect of privacy and data privacy and the restrictions that sit on this information. You're actually not free as a tax administration to run any AI over any data set for any tax purpose, even if the information is fully confidential. There's cyber risks that come with that level of information. There's the question on ethics and whether there's an inbuilt bias in the AI. So there will also be new practice areas. So we won't be unemployed.
Yeah.
Sure. Sorry.
Yeah, no, I just wanted to add to that, right? So I feel like I totally agree with you. I think that the way the use of technology is going to alter our profession, number one, is first of all, the way in which we assess risk in transactions, right? I don't think as tax advisors you will have the ability to build a tax narrative post the fact. So tax is definitely going to be an upstream activity for all purposes, and the use of AI tools both by tax administrators as well as businesses in tax planning structures to detect, where are the holes or where are the loopholes. I think the second is this idea about having a new version of fairness or due process, right? When you have technology underpinning tax administration systems. So one point being about, and this is so because it's so different in our tax culture. So when I was in a conference in Europe and they asked, so what is the legal basis for data analytic tools? And I said, what's not illegal is legal. Why aren't you allowed, why is the government not allowed to process your data and use it to get, identifiable information on whether to proceed or not? And there were questions about how that has an interface with GDPR and how there are limits on how your data can be analyzed by the government to carry an audit for you. So I do see that as an emerging area for tax practitioners, this intersection between tax and privacy law. And of course, fairness in terms of systems integrities, right? How do you ensure that these technological systems are doing the job that they're meant to be doing? How many times have you been trying to file a return on the last day, but the websites crash, so now your losses have lapsed and you need someone to file a case and plead your case? And that is a disadvantage to the taxpayer. So who's auditing these systems to ensure that they're working in the right way or are free of biases? Because AI is in fact trained on certain information and data that is fed to it.
Okay, very quickly, Claudio, let me go to you. So given how AI is unfolding, maybe Gen AI is expected, do you see this as completely changing even the top end of the tax work, consulting, brain power, structuring, and so on? And will the taxpayer with a very low stake also now have easier access to the best advice because it is coming from tools, technology, relatively easily accessible rather than just a few brilliant men having the ability to deliver on that? Like, for example, in the education space or in the healthcare space, it seems that AI is going to bring a totally new paradigm where the best of educators will be able to, I mean, the poorest of kids will be able to have access to the best of educators through AI, and the best of healthcare through AI, although there might be very few human doctors, so to say. So will this really become a leveler? Will it become inclusive? Taxpayers with very low stakes will also have access to the best of tax advice thanks to technology, thanks to tools, and so on. And will it therefore be a leveler even between large firms and small firms, or individual practitioners and large firms, because these tools will offer everyone an equal opportunity to get access to the best of tax advice, structuring, planning, and so on?
Yeah, I see a potential change in the future for the role of tax advisors here, because probably they should be more focused on, monitoring how AI effectively works, if AI works well in practice. So probably I see there the new role of tax advisor in controlling what happens with AI if a processes work well. And also I would like to add something that is really important for discussion, in my view, also for the potential of blockchain and what can really do for changing the role of a tax advisor. If we will see in the future a blockchain infrastructure used by companies to record the transaction there, their accounting there, and if we will have also tax authorities joining, having access to all the information stored in real time in a reliable way there, well, probably there we do not see anymore the reporting as it is nowadays, because in the end we will have real-time information recorded on the distributed ledger, and this could help to simplify also certain activities of the tax advisors and leave more time free for them to focus on, monitoring how technology works, than of doing some, some activities of mere reporting, which are, very time consuming.
Excellent. Ravi, why don't we go on to the third theme, Web 3.0.
Right. So I'm glad to be here. Hats off to my fellow panelists. It's been a great opportunity to share with you. And I think my topic is going to be about Web 3.0. And I think the best way to start off today is sort of to take a step back and contextualize a bit the way um, the evolution of the web, and in order to kind of highlight the manner in which blockchain plays a role in the emergence of this new iteration of the web. We hear now a lot Web 3.0, and I can imagine some people thinking, I didn't even know there was a Web 1.0. And so it might be useful to kind of sort of go back and evaluate these versions of the web. And so Web 1.0, we go back to the 90s, and this is about the time when the World Wide Web came about. And Web 1.0 consisted of these sort of static pages. It's just simply a content delivery page that didn't require much interaction from the user, right? So the user's access right was that only to read the information that was displayed to them. So the way you want to think about that is the way a personal blog might work, or think of Wikipedia, where simply information is provided to you, but no input is required from the user side, simply only to read the information that's being provided. And so, we fast forward from 2004 until today, and we find ourselves really in the midst in the crescendo sort of Web 2.0. And so Web 2.0 is no longer about static pages, but rather these sort of dynamic pages that generate on the fly. It's a more social, participative web in which users can make inputs and interact with information. So you have to think this in the way social media companies exist, and you may be a user of that platform, but at the same time, you may also be a content creator, right? So Web 2.0 requires more of an interaction from the user itself in creating content in this new space. You think about the way, and the premise here for Web 2.0 is that the business model is a two-sided consumption where there's a centralized intermediary, right? So you think about the way Uber kind of connects a driver with someone that's requiring someone to drive them anywhere. Or you think about how a homeowner wants to rent their property to a renter, and so they do that through a centralized platform like Airbnb. And so under this model, Web 2.0, the user's access right is that to be able to read the information, but also to write. And so the question then becomes, well, what would Web 3.0 be? If we can already read the information and now we can read and write, Web 3.0 would be the ability to do both of those things, but in addition to that, to own digital assets. And this is key because, up till now, Web 2.0, if I were to send you an image, the image that I'm sending you is a copy. It's a copy that I get to keep. It's a copy that the centralized server of the email hosting party gets to keep. And then you, the beneficiary of that email, you keep a copy of that. And the reason why one could not own a digital asset, because there was no place to register that information. And so blockchain functions as a ledger. So imagine now you have a ledger where information can be recorded, where I can record the name of someone and the ID of the asset that they own, and then transact that. So that's why blockchain plays a pivotal role in the emergence of Web 3.0. Because now as a user, I can own a digital asset, and that can be recorded in a digital ledger. And so the premise here is that there's a two-sided consumption similar to in Web 2.0, but now the model is one without an intermediary. It's decentralized. And so perhaps a good way to really evaluate sort of that paradigm shift between Web 2.0 and Web 3.0 is it's in this slide. When you think about payment mechanisms and in commerce, when we make payments, we do that through fiat currencies, your local currency that we use in each jurisdiction. But in Web 3.0, the currency that's being used there, or sort of the asset that's being used there as a form of payment, is going to be cryptocurrencies, right? Similar in the way ownership works. Ownership currently, it's done through formal titles that are operated by the law, whereas in Web 3.0, we're looking at NFTs. And remember, these digital assets, we can own them, and it's operated more by the smart contract itself rather than the law. When we think about finance, the world of finance gets disrupted thanks to a technology known as smart contracts, which is simply code. conditional codes. If A occurs and B occurs, then result should be C. So that action that an intermediary used to do before, if it can be automated, then why not take that approach? And that's sort of what Web 3.0 seems to offer. It's this ability to get rid of the intermediary's function and have that being replaced by code, especially when it's sort of these binary decisions that need to be made. And similarly with governance, instead of having it sort of centrally owned, we have this new concept in Web 3.0, which are known as DAOs, decentralized autonomous organizations. So that fiduciary work that used to occur at a centrally owned governance now is sort of decentralized. It's no longer vertical, but rather sort of horizontal. So everyone holds governance tokens, and based on that, they can make decisions on the overall movement of an organization. So that's sort of the way some of the ideas that come up with Web 3.0. And so a lot of people have the question as to whether, we hear the word Web 3.0, we hear the word metaverse, we hear DeFi, which is it? Which is the future? Are they all the same? In what way do they kind of interact with each other? And really the way to think about this is quite simple. Web 3.0 is the backbone. It's this wider concept. And from that wider concept, really sort of applications begin to emerge. So the metaverse is really just an application within the larger universe that Web 3.0 is. And that's facilitated thanks to NFTs, which are a specific type of digital asset that are non-fungible, they are unique. And in the world of DeFi, which is this decentralized finance, it's similar. It's just another application within the Web 3.0 space that's sort of where the underlying, let's say, asset that's used there are other crypto assets as well. And this is all enabled thanks to automation, which is what we know in this space as smart contracts. So smart contracts allow for automation. So if things can be automated, is it still necessary to have the role of a central intermediary to do those functions when they can be automated? And so, when we think of DeFi is not too difficult to imagine because we interact a lot with financial services. And so we simply imagine not having a world where there's an intermediary. But the more challenging one to really envision is the metaverse. What are some of those business cases for the metaverse? And so we are sort of at the beginning phases of this sort of revolution, if that's what we want to call it. And so there's a lot of testing being done by companies and sort of trying to figure out where the real value is in this universe. But some examples of what we've already seen is, for example, retail companies sort of establishing shop in this virtual space. And from there selling NFTs that may be linked to a physical asset. So imagine going to a shop and buying a shoe and that being linked to an NFT, which is in the metaverse. Or just simply purchasing an NFT that's not linked to a physical asset. So you can already envision transactions occurring in the metaverse that are not necessarily linked to anything physical. And so that already begins to challenge some of our notions and the principles upon which we've built our international tax frameworks, right? We also find, for example, in the entertainment world, how certain concerts have already taken place there, in which it's simply an avatar making a performance and people joining to that live performance occurring all in the metaverse. There's once again no actual link occurring in the real physical space. We also find legal and financial services. For example, Gleiss Lutz is one law firm in Europe that set up shop in the metaverse. For example, we also have HSBC and JP Morgan that have set up shop in the metaverse so that people that wanted to receive certain financial services could do it through that space. And for example, we also see virtual real estate developments also occur in the metaverse. So I guess in summary, what I want to add here is that it's really important that when we think of Web 3.0 and we think of blockchain and sort of these crypto assets, it's not with the argument to replace what we currently have. Like most of the discussions that happen here, it's never about, oh, let's have crypto assets or replaces currency. That's not the real aim here. It's rather there's this new segment that's kind of emerged. We have a new type of asset that will be used as a means of exchange in this new space. And so how do we address that space that no longer has necessarily a physical nexus to a jurisdiction? So again, the lines between borders have kind of blurred. And it's important to just really evaluate this, where this new space is going to go, and see how that sort of interacts with our tax system. Thank you.
Thanks so much, Ravi. I mean, Ravi, we are still struggling to figure out how an intangible asset is to be taxed. So it has been with us for ages, right? We are not sure where it is located, what's the situs, how to tax it. We are still struggling on whether the concept of physical permanent establishment is relevant any longer, how to tax the digital economy, and so on and so forth. International debate continues. In the midst of all this, you're talking of Web 3.0, metaverse. I don't even know whether I understand what I'm in for. What are the tax challenges? What questions should I ask you? How are we going to, how is tax going to adapt to this meta universe? How is the tax universe going to adapt to the meta universe?
I was hoping my presentation would have clarified that. Well, I think so. When you think also about the two-pillar solution, right, and you think of Web 2.0, really Web 2.0 comes to realize that you no longer need a physical presence in a jurisdiction in order to do business, right?
Correct.
And so that's sort of the premise upon which that the developments are currently occurring in the international landscape. And so
they're debating that.
Right, and most
no solution.
No, but most efforts is really going into trying to address Web 2.0.
Yeah.
Right. So now imagine that we've taken out some of the features in Web 2.0, for example, having an intermediary from whom we can get the information. And we say, well, now we're moving to the future where there's no intermediary. It's a general challenge. And so the two main challenges that occur here in Web 3.0 are the following. It's income characterization and then it's nexus. So from an income characterization perspective, really, what occurs is that if jurisdictions take different views on how the income is going to be taxed, then you're going to have these divergences, even from the perspective of double tax treaties. Because one might say, especially with intangibles being usually a very complicated topic, do I view the income, if I have a virtual property in the metaverse and I sold that property, do I view it as an immovable under the double tax treaties? And then to which country do I allocate that income? Do I view it as business profit and then say, it goes to the residents? Whereas some countries might say, it's a royalty payment because it's an intangible, and you know what? That should be shared with the source, because many tax treaties include a withholding tax at source. So income characterization is one of the challenges that arises here.
And where is that income arising? Where is that owner? Where is that avatar? Where is that NFT or the virtual asset located?
Well, I think Liz proposed something like in space, outer atmosphere taxation.
We're going to do mining or maybe some power generation on Mars or on the moon.
One point I'll add about this, it's that when you think about, if you were to say that Nexus is where the end user is, the issue that arises with that is, how do you know where the end user is? Like if you think of a company that provides advertisement and publicity, usually they target their audience to a specific jurisdiction. And you can always, most of these companies will have the IP addresses to whom they're targeting an advertisement. But in the case of the metaverse and in Web 3.0, that information is not really stored anywhere. It's not stored on the blockchain. So to use the end user's location as perhaps as a proxy to saying, yeah, that's where taxation should happen, is not as straightforward. And so that's kind of interesting to take into account as a real challenge as to how things will move forward.
Maybe just a quick one, and I know we're running out of time. I mean, two things. I mean, one of the things, and Guri, you've also said, and I think it's important, that the Tax Administration 3.0 suggests to embed taxation processes in the ecosystem. And the idea also is, as the ecosystem evolves, we need to continuously thinking about what that is. And so it's a very flexible concept. It doesn't necessarily require a central intermediary. It could be something else. Sometimes there's a bilateral relationship. It can be a multilateral relationship. It can be a tripartite relationship. It can be also a technology solution, right, inside the ecosystem where the reporting is. I think that's one. And the other thing, just to throw out fascinating questions, but in some sense, even in the Pillar 1, when we came to the end of the data availability, even Pillar 1 at some point, for instance, goes to GDP and allocation codes, right? So there is already sort of a question, what do you do when you do not have access to underlying transactional information, which may not be the answer, but we're close.
So Ravi, do you think Pillar 1 is solving anything so far as Web 3.0 is concerned. Forget anything else. You don't look at him, you look at me.
I think that pillar one asks the right questions about, you know, how does one try to allocate to a jurisdiction based on what sort of features you use to do that. I'm still not utterly convinced that in the case of Web 3.0, that could be entirely captured by Pillar 1. So Pillar 1 might be able to capture some of the activities that occur in the metaverse. Definitely in the case if you think of an NFT that's linked to a physical asset, and it might be easier to make a link to a jurisdiction. But in the case of these virtual lands that are occurring and where the people that develop this environment are so many, and you don't have the idea of even these people,
Diverse.
it makes it a lot more challenging to even enforce some of the elements that are part of.
Okay, excellent. I'm afraid we are really running short of time, but I must say I have learned a lot. Thank you so much to this wonderful panel, and thank you to all of you for a very patient hearing.
Thank you. Thanks, everyone.
Thank you so much, panelists, members. That was really, really very interesting stuff coming up ahead for the future of the world as a whole. And